we've seen some really interesting work with individual clients. They were bringing in huge amounts of external data, but it was very difficult for the underwriters without the risk scoring structure around it to understand the so what of it.
You're listening to Rethinking Insurance, a podcast series from WTW where we discuss the issues facing P&C, life, and composite insurers around the globe, as well as exploring the latest tools, techniques, and innovations that will help you rethink insurance.
Hello and welcome to Rethinking Insurance. I'm your host Anand Patel, and today we'll be exploring the concept of risk scoring within the commercial lines market. This podcast is inspired by our video series Thinking Unbound, in which we explore the latest trends and challenges facing the commercial and global specialty markets. If you'd like to watch the full video on this topic, please search for Thinking Unbound on our website wtwco.com. Today I'm joined by our guests Rajeev Janagal and Jonathan Aubrey-Smith. Thank you for being here. If I can start with you, Raj. Raj, you recently did a talk at Lloyd's Old Library around risk scoring and how the market was trading differently going forwards around enhanced underwriting, portfolio trading, digital trading, however you want to kind of describe that concept. And through that mechanism, we've seen the concept of risk scoring being emerging. Can you give us your take in terms of what do you mean by risk scoring, and then why is that important today?
Sure. So for me, risk scoring is very much taking the granular risk information that an insurer has, particularly in the London market or in specialty lines of business, and forming a view of the quality of that risk, which is kind of separate from pricing dynamics. So adherence to underwriting appetite statements, adherence to underwriting strategy. That kind of then gives the ability for an insurer to form a view of the risk score, both on an individual risk and across a portfolio, which can feed into other things downstream. In terms of the kind of importance today, we're seeing new and different techniques in the market around the way that insurance is traded and how insurance risks are managed as a whole. And the scoring that we're seeing can feed into both decision making, but also into the metrics that are used for that decision making kind of across an insurance business.
I think there's also a really interesting sort of take around how that risk scoring begins to be absorbed into the market as we move towards a portfolio-driven world, as we're seeing this an enhanced underwriting approach. Whether we're talking open market underwriting or whether we're talking portfolio underwriting, the ability to assess and track whether the risks you're underwriting in one lens are a reflection of actually what you're intending, but also leveraging third-party data to bring in additional viewpoints for our underwriters so they can have more granular and clean understanding of what that risk is. And therefore they can more easily track it over time, understand it, how it relates to the wider portfolio. It gives a powerful new lens over and above the historic choices around price or even simple tiering. It's taking that next step forward and reflecting those core market changes.
That's really interesting in terms of managing business through what appears to be a new metric, which is necessary as that market trades differently going forwards. It's different to price adequacy, price loss ratio, which are the more traditional metrics that people will be using to effectively manage business. If insurers do make the investments as part of that risk scoring process, how should they go about doing that, and what value will it unlock for those insurers going forwards?
I think one of the key value pieces here is a consistent understanding of risk. One of the big challenges I see consistently across the market is whether you're looking at a traditional DA portfolio, a portfolio solutions business taking a tracker position or an open market position, is because you're now working across multiple different work streams and different types of risk are coming through. Your ability to assess those risks on a like-for-like basis is much more constrained. And I think that's that key enabler. Ultimately, portfolio management has been a core part of our business for a long time. But as we move into more portfolio-driven underwriting, as we move into this world where leads are more dominant, followers tend to or may become increasingly digitized, your ability to understand the nature of your portfolio and the consistent risk across it, and actually are you making different decisions in different places? That's not a bad thing to do, But the problem is, do you know you're doing it? And risk scoring enables that portfolio management to be much clearer and cleaner. So you're much more concerned about what's actually happening and taking the actions that you need to about that portfolio divergence. It gives you an opportunity to get down into the detail, where historically we kind of lose a lot of the grain, particularly in that portfolio world.
I think for me, right now, it's unlocking these new mechanisms of trading, particularly algorithmic underwriting. I think we're starting to see models stand up that are very yes-no, and I think risk scoring gives you the ability to form a view of, is this risk in appetite, and therefore I can have a model make a decision potentially rather than a human in some instances. But also then off the back of that, the model has a view of what the quality of that risk is. Is it okay? Is it very, very good? How does it adhere to appetite and strategy? And then can make more nuanced decisions off the back of it. I think longer term, the scoring gives people like actuaries, data scientists, the data to perform more advanced analytics. I think as you're seeing more and more business traded through these new mechanisms, you can use the data, the granular scoring that's generated into those advanced analytics, getting better parameterization of models moving forward and better development of models moving forwards in the underwriting space.
That's really interesting, and I think both of you also mentioned data as being such one of the kind of the key enablers to risk scoring. Is that data sort of internal data? Is that data that's provided through the traditional mechanisms from brokers? But also, actually, I'm probably more interested around the use of external data. Does that have a role within risk scoring as well?
Absolutely. I think one of the key opportunities here is this is a way of bringing in external data into your decision making in a structured and controlled way. One of the big problems, let's be honest, the market's gone from talking about we don't have enough data to going, how do we handle all of this data? And actually, one of the roles risk scoring can help play for an organization is to give shape to that data, to make it more easily understood by the underwriters, the portfolio managers, the actuaries, what that quality of risk is. So using those third-party sources, giving you a way of shaping those gargantuan data sets. We've seen some really interesting work with individual clients. They were bringing in huge amounts of external data, but it was very difficult for the underwriters without the risk scoring structure around it to understand the so what of it. It's a case of, great, we now know this particular risk factor about this particular risk, but it was in such a huge dimension that it made it difficult to digest and go, okay, so from an underwriting action, that means I should do what? Or that means it's better or worse or otherwise. And for me, that's where risk scoring plays a really critical part in helping enable that.
I definitely agree with Jonathan, but I think for me, data in the context of risk scoring depends very much on the use of risk scoring. So we talk about risk scoring in lots of contexts, and if you're in a more simple context, simple decision making, it might just be that the data is the data submitted by the broker at submission, or data about a few risks that you're looking at. I think absolutely when you're broadening out and you're looking at portfolio management or how do we bring in those external sources, risk scoring is a very good mechanism for it, but ultimately it depends on your use case.
Thank you very much. A very interesting development in terms of the way that the market will trade differently going forwards and how the concept of risk scoring will be critical to that success. Jonathan, Raj, thank you very much for sharing your perspectives. And to all our listeners, thank you for joining us today. And if you found this interesting, then make sure to join us on future episodes of Rethinking Insurance.
Thank you for joining us for this WTW podcast featuring the latest perspectives on the intersection of people, capital, and risk. For more information, visit the Insights section of WTWCO.com. This podcast is for general discussion and/or information only, is not intended to be relied upon, and action based on or in connection with anything contained herein should not be taken without first obtaining specific advice from a suitably qualified professional.